It feels like the only thing that's certain these days is uncertainty.
As we look down the road, though, we see there's plenty of reasons to be optimistic. And I think that's what the market's risk assets are kind of pricing to right now in terms of, let's say, corporate earnings and generally strong economic growth momentum. But what we don't know, and I think the market may be underestimating, is just the degree of uncertainty related to tariffs.
That's James St. Aubin, Chief Investment Officer at Ocean Park Asset Management. And in today's big interview, he makes the optimistic case while suggesting that you better be also protecting yourself against the downside. But up first, Mark Gatto, Co-Chief Executive Officer at Scion Investment Group, returns to The Navigator, talking this time about private investments and how private markets have been functioning amid all the uncertainty. Plus, Adam Bierman, author of Weed Empire, How I Battled Gangsters, Investment Banks, and the Department of Justice to Build the Cannabis Industry in America, is here talking about his book and the evolution of an industry that certainly is fascinating and different.
Gentlemen, start your engines.
You know, you might think that we would save the Gentlemen Start Your Engine sounder for next week when you're getting ready for the Indy 500, but today is NASCAR Day. So, you know, at the end of the day, when I tell you what we're celebrating, today's NASCAR Day, so you can start your engines today as well. We have our engines started and revving for a great show for you today. The interviews are going to run long, so we're going to keep the intro as short as I pretty much possibly can. But I'm Chuck Jaffe, your host, and this is Money Life for May the 16th. And yeah, you can't talk to anybody these days without kind of bringing in the uncertainty topics and then talking about tariffs and all the rest. But you are getting more and more optimistic takes on things. It's just the question of, like, do people believe it? And I will point out that we might see the market continue to pick up today. The futures were suggesting that it would. So we'll see whether or not we have a fifth straight win. And so you go back like just a week and a half ago, whatever it was, 2 weeks ago, and you had 9 straight winning days, and now you could have 5 more. That doesn't mean we're out of the woods. As I've said in the past, you could make a strong case just using technical analysis that we're going to retest the April lows. Given how far we've climbed back, retesting the April lows would make us all feel pretty miserable. But that's why you want to be thinking about where things are going and how you want to be positioned. Because unless you're one of those folks who does not look at all, and then the risk is that you look at the wrong time, that's its own separate sort of risk, I guess. Well, we want to get you better positioned. So we're going to jump straight in on this show, but remember, you can reach me at chuck@moneylifeshow.com, and remember to stick around to the end of today's show when we will start a contest for Adam Bierman's book, Weed Empire. It's a very fun read, a little different for us in terms of subject matter on the show, but worth doing because it is a money, life, business kind of topic. Again, our lineup, Mark Gatto, Adam Bierman, James St. Aubin. The Navigator kicks us off next.
Dig deep into business development companies at the Active Investment Company Alliance 2025 BDC Forum. It's Wednesday, June 11th in New York City. A full day of big names in BDCs at the podium or on informative panels and networking opportunities with fund sponsors, asset managers, institutional investors, and others who are actively involved in business development companies. Advisors can get 7 CE credits for attending. Go to aicalliance.org/events for the full schedule and details. Use the code NAVIGATOR20 for a 20% discount on your registration fee.
We're talking about how private markets respond to economic uncertainty with Mark Gatto, Co-Chief Executive Officer at Scion Investment Group. This is The Navigator. Welcome to The Navigator, where we talk about all-weather active investing and plotting a course to financial success with the help of closed-end funds. The Navigator is brought to you by the Active Investment Company Alliance, a unique industry organization representing the full spectrum of the closed-end fund business, from users and investors to fund sponsors and creators. If you're looking for excellence beyond indexing, the Navigator will point you in the right direction. And today, we are pointed in the direction of private markets with Mark Gatto. He is Co-Chief Executive Officer at Scion Investment Group. You can learn more about the firm at Scion, C-I-O-N, ScionInvestments.com, or at ScionBDC.com. And if you want to learn more about closed-end funds, interval funds, and business development companies generally, go to aicalliance.org, the website for the Active Investment Company Alliance. Mark Gatto, welcome back to The Navigator.
Thanks, Chuck. It's a great pleasure to be back.
As much as everybody's heard about private markets, I'm not sure that many people understand exactly how and why private markets might respond differently to the headlines that we've been seeing than the public markets. So help us understand, how have private markets responded to this unusual news cycle?
So the beauty of private markets is that it is less liquid than the public markets. And with that, you get to dampen the volatility that you would typically see in a publicly traded stock or from a public bond. And that's one of the great merits of private assets, is that we as investors can think long term. And the public investor or the retail investor that invests in these assets, they don't have to be in a situation where they're looking at the stock price every day or the bond price every day, because the assets don't mark to market like typical public security. So it gives investors the opportunity to access an asset class that doesn't move up and down so quickly and react to noise, if you will, right? There's a lot of noise out there in the markets today with the advent of social media and the way news is disseminated today, that the public markets really whipsaw back and forth. And that could be problematic for an individual investor to really digest what's going on. For a professional investor in the public markets, it's probably a great opportunity, right? I think if you talk to anybody on Wall Street, they'll tell you volatility is a good thing. They make money in an up market and a down market, but that's not the case for individual investors, because they're not on the front lines. They're busy doing what they have to do on a regular basis, and they don't have the ability to either do the research or execute in the same manner a professional does. So by investing in private assets, you get the ability to sit back a little bit, right? And let things play out and allow these assets to weather the storm. And that's, I think, the beautiful thing about private assets, is that when we invest in a security, a private security, an illiquid security, we're thinking long term. We're buy and hold. We're not looking to trade these assets. So when we underwrite them, we're making sure that they can withstand shocks to the market. And you see that in the funds that we manage. You see that in the other private asset structures that are out there, where you've seen more stability in the pricing of those assets. And as a result, investors get a better experience, in my opinion. Now, it's an asset class that isn't exclusive for somebody to invest in. You're not going to invest all your eggs in that basket per se. You're going to have public exposure, but it certainly is a ballast to any portfolio that allows you to analyze what's happening, let things settle in, and see what the real effect is long term. And as a result, I think you get a better performance. And that's why we're advocates of a well-diversified portfolio that includes alternative investments.
Is there some benefit to the way management can react to the headlines in private markets? Because as much as you'd like to have every CEO and chairman be like Warren Buffett and stay focused on the long term and not really worry about what they're doing that makes their quarterly numbers, we know that there's tremendous pressure on corporate executives to make the quarterly numbers. And that's not to say that they don't get the same pressure in private markets, but you'd like to believe cooler heads can prevail. We don't have to set up a number and have it whipsawed to the whims of the general public. So are there benefits that private companies have that public companies don't, that as an investor, you can watch them maybe get an advantage here?
Absolutely. And I think that's a big reason why you're seeing more private companies today than public companies, publicly listed companies, than we saw years and years ago, right? The ability to think long term and not, quote unquote, manage the number is a great way to run a business. And you have the ability to sort of, not react, not sort of have a knee jerk reaction to something that's happening in the market just because your quarterly numbers coming out and you need to do that to keep the stock price up so that your bonus plan kicks in, et cetera, et cetera. You could think more strategically. That's what we see in the companies that we invest in, is that they're making decisions based upon the long term and what we see as a more sustainable path forward. And we see that in our portfolio. We speak to the management teams on a regular basis, especially when there's a situation like we're seeing today, where there's volatility in the marketplace, there's some uncertainty around the economy. We as managers are getting ahead of that. We're talking to the management teams that we invest in and trying to understand what they're doing to mitigate the risks. And we also see that in specific names that we're more involved in, where we maybe have a small equity position or we're on the board. And we talk about these things on a regular basis. And it's not only in times like this where there's uncertainty, but we do it consistently and constantly throughout the process. We're always thinking about where should we be producing? How should we diversify our suppliers? And those are the things that make good companies. And like we say all the time, when we're looking at an investment, we want to invest in a good management team. That's the most important thing, right? Because companies, they go up and down, and there's certain outside forces that affect the performance of a company. And at the end of the day, it's the management team that's really going to get you through those issues. So investing in good companies with good management teams is really important, especially in times like this.
Do times like this ever convince you that, hey, this management team, we've confused a bull market with brilliance? Like, this guy seemed great and this team seemed great, and now that we're watching them under fire, they don't have it? Like, does that happen where you go, you just got open stress tested by the market?
Of course it happens, right? Hopefully it's a rarer occasion, and it's a minority of the teams that you invest in, but of course it happens. And what we do to protect ourselves or protect our investors from that is we negotiate covenants and documents, triggers, if you will, that allow us to have a seat at the table and ultimately push these management teams, these CEOs, to do what we think is in the best interest of our shareholders and our investors. So it does happen, but more often than not, you see a situation where the management team, the CEO shines, and they really give you the confidence that the business is going to flourish regardless of the situation, or certainly outperform its peers and others that we're competing with in the space. And I think that's more common than not. And we've seen that. We've seen the resiliency of the private markets, of private companies. It's unfortunately, it's happening too often, right? Where there's a test that comes up and you get to gauge whether or not you did invest in a good business or a good management team. And point in case is COVID, right? Well, we thought the world was going to come to an end, and the economy was going to fall off a cliff, and every company that we were involved in would have a real difficult time long term. And just the opposite happened. Obviously, there was some support out there from the government and the like, but at the end of the day, the resiliency of the management teams and the businesses really came through, where they were able to restructure their business, they were able to lower costs and still be profitable. And that's what you're looking for. You know, in good times, everybody looks good, right? Everybody looks smart, but it's in tough times is where the stars shine. And fortunately for us, throughout our businesses, our funds that we manage, that's been, more of the case than not.
What the market investor, what the public investor has seen is a market that peaked in February, cratered after Liberation Day, and has subsequently bounced back and recovered everything. And as you point out, in private markets, you may be taking the ride, but as an investor, you're really not, because you're kind of locked in and it's illiquid and all those other sorts of things.
There's no exit door, so to speak. You're on the roller coaster, but you can't exit.
Right. So does that basically mean that it's been a flat experience, or are we at a spot where the private markets, you can kind of look and go, yeah, actually, we're ahead of the game at this point? Or can't you tell? Because again, no exit. So you can't.
Listen, I would argue you're ahead of the game, right? Because you're proving out the thesis. You're showing the market that these types of assets are resilient, and they do provide a level of protection. They do mitigate volatility in a portfolio. So it makes the case that you should have more of it, subject to your particular risk profile, your liquidity needs, et cetera, et cetera. So I would make the case it makes the case stronger for privates, and it makes them more attractive, which creates value. And that's what we're trying to do is drive value. So if these investments, these underlying investments in private companies become more desirable because they do stand up in these situations, well, that's going to increase the price of them and the attractiveness of them. So it inures to the benefit of our ultimate investors. So I would argue it improves it. Now, by how much, I guess, remains to be seen, but you haven't seen a major pop in the price of the assets per se. There has been some improvement, but at the end of the day, you look at the landscape and you say, okay, well, this is interesting. We had a situation where tariffs were in play and the public markets reacted in a certain way, and private markets kind of sort of stayed the course and watched it very closely. That's what we did. And we were talking to our management teams, making adjustments in the background. But ultimately, we're in a situation now where things are becoming more settled, more stable. It just goes to show you that private assets are a good place to be in periods of uncertainty and volatility.
Mark, really interesting. I know we're going to continue to watch it. You guys have a lot of different business lines at Scion. So we'll talk with you again, maybe about private, maybe about other stuff. But meanwhile, thanks as always for joining me on The Navigator.
Thanks, Chuck. Always a pleasure.
Mark Gatto is co-founder and co-chief executive officer at Scion Investment Group. Learn more about the firm at Scion, C-I-O-N, ScionInvestments.com. Later on Money Life, James St. Aubin of Ocean Park Asset Management has the big interview. But up next, I'm talking to Adam Bierman, author of Weed Empire.
Smoking.
Oh, yeah.
Did you know that there are at least 23 million American adults who can't read a want ad?
It's called reading. Top to bottom, left to right. Group words together as a sentence.
Money Life presents
I'm chatting with my guest, author, lecturer.
You get him to open his mind and his future.
The Book Interview.
Give a kid a book and you'll give a kid a break.
That's gonna be radical, Chuck.
Reading is good. Can we start the story now?
Oh, we most assuredly can start the story. This is going to be one of the wilder stories we talk about, and it most assuredly is not our standard book interview because most of the time we're talking about books that have to do with investing, but occasionally we discuss books that have to do with businesses. And this is a really interesting one about a business that is very different from most. My guest is Adam Bierman. His book, Weed Empire: How I Battled Gangsters, Investment Banks, and the Department of Justice to Build the Cannabis Industry in America. Adam was one of the founders of Mad Men, which was one of the real originators in the cannabis industry, became one of the first public companies in the cannabis industry. It also became a company that went bankrupt. But Adam, to the best of my knowledge, was out by the time the bankruptcy occurred, etc. But there was a lot of drama. The drama, I remember, was in what was happening with the company at the surface level. The book goes into all of the backstory, and it is indeed wild stuff. If you want to learn more, the Adam Bierman, BIERMAN.com is his website. There's book information there. We have a link directly to the book information as well in our show notes. And we've got a contest to give away copies of the book. You can enter for that at the end of the show. Adam Bierman, welcome to Money Life.
Thank you so much for having me. I'm excited to be one of the rare interviews. I like being the rare. Yeah.
Because while my audience can learn from your story, it's not the standard entrepreneur story, or maybe it is, because of all the businesses you expected to get into, cannabis wasn't one of them. You did not set out and go like, hey, I'm a big stoner, I want to go into the weed business. So explain the genesis of how you wound up in the Wild West that wasn't just the beginnings of the cannabis industry, but still seems to be the cannabis industry now.
Circumstantial, I think some people use the word fate, but I found myself in my 20s, struggling to find a footing as an entrepreneur, wanting to build a life for myself, not necessarily tied to any one category or industry, but more tied to hunting, opportunities or an opportunity that, could provide for me and my future family. As I account for in the book, in one of, the most desperate kind of scenarios I found myself in early in life, no car, living with my parents, with my girlfriend, just trying to find something I walk into a pot shop in Hollywood and I meet this blue-haired lady, and she introduces me to the world of weed.
And how quickly did it go from you were introduced to the world of weed to this is the business, this is what I want to get into? And how unprepared were you? Help people understand just how little you knew. You knew the entrepreneurship side, but how little you knew about cannabis, because cannabis is not the same. It doesn't deal with banks the same. It doesn't deal with markets the same and all the rest.
Yeah, I mean, that was 2009 that I had the meeting in Hollywood when the lady, as I account for in the book, wanted to hire me for some marketing services. And she starts talking to me about her business, the numbers in her business, operating out of this dingy, small space off Sunset Boulevard. My mind is blown. And to your point, you use the term unprepared, just unprecedented, you know, looking at that woman's store and then kind of looking out from that and looking at maybe a greater opportunity. The opportunity that I had to envision along the way was an unprecedented one, right? It was an opportunity that had to be envisioned and then manifested through all the craziness that you're referring to that, we talk about in the book. So full acknowledgement at that time in my life that I had to make something work. Weed seemed to be an opportunity that I needed to figure out. And I was just in a place in my life where I was willing to figure it out at all costs. And I find myself at this intersection of history where, based on, my previous life experience, my DNA, and the fact that, maybe fate brings me to Hollywood in 2009, I end up being in this situation, really helping to drive this movement to end prohibition and simultaneously build a permanent asset class, an investable asset class, a legitimate industry.
Well, legitimate and prohibition, key words here, because like prohibition with alcohol, which I've read plenty about, well, the weed business faced a lot of pressure from the illegal side who didn't want to see weed become legalized. And you hear about that pressure, but you experienced it firsthand. Give a for instance so my audience understands what that was like, because that's not the normal entrepreneur experience dealing with competitors.
Well, I think there's this aspect which I know makes the book wildly entertaining. It happens to be the real story of my life that I've led. But, we're dealing with criminality. And the one thing about cannabis, which is now the term that's used because it is an industry and there are public securities that you can buy businesses in that industry. So we'll use the term cannabis. We can put whatever term we want on it. We can have these companies listed in Canada, but operating in the US under very, very strict guidelines, being banked in the US, taking international money. We can do all that. And we can pretend that in 2009, when I get introduced to this, when none of that's happening, that we are in, the criminality zone. And by the time I leave MedMen, we are in the daylight, legitimized and paying taxes. But the truth is that today, as we have this interview, May 13th, 2025, marijuana is federally illegal in the United States of America still. So it was important for me to share my experiences, at this transition point in history, at the end of prohibition. God, wouldn't it have been amazing if we were alive at the end of alcohol prohibition and you're hearing the real stories of what that looked like and what was going on behind the scenes and how those laws evolved and who the players were? Like, wow, fascinating. I get to watch that stuff on the History Channel, 80 years later. We don't get to learn about that real stuff in real time. So for me, in real time, sharing these stories, I'm sure they're no different than the end of alcohol prohibition, but we don't get to live through the end of a prohibition that often, right? And I just happened in this one, finite moment in history, be the tip of the spear in that movement, marching towards that end and then dealing, as you said, with everything that comes with it. And we're skipping way ahead in the story, but even once becoming a public company, after being the first of all of the stuff, the first unicorn, the first pubco to be trading the way that we were, all the things that we did, we were still a federally illegal business. And I still had to deal with that reality every single day.
And that, by the way, is why, and I don't want to focus on this because we're going to run out of time and there's too many other good things I want to cover. That's why marijuana businesses have issues with the banking system and all these other sorts of things that still make it difficult to grow. Let's talk a little bit about MedMen does go public. You are dealing with everything that you need to build, but this is not just the Wild West in terms of what you're dealing with on the regulatory Department of Justice. Where's it going to be legal? Where's it going to be illegal? But also, there were a lot of folks, and still are a lot of folks, sort of trying to say, I want to be the ones controlling the market on cannabis. So I'm curious, which was more Wild Westy, the dealing with the gangsters or the dealing with Wall Street money men?
Oh, the biggest gangsters are Bay Street money men, not Wall Street money men, because I end up in Canada in this story. And, Bay Street and the OSC is a very different animal than Wall Street and the SEC. There are some stories in the book about the insanity of the public markets in Canada. But maybe this is a helpful answer to your previous question. For instance, right? For instance, as a federally illegal business operating out of the state of California at the time, but wanting to legitimize ourselves by way of going public, we figured out a way to go public in a foreign country on their junior stock exchange, when at the time our market cap on day one of trading was larger than the entire combined market cap of that exchange. So it's not just, and there are accounts in the stories of the bloody punch out, violent criminal stuff that maybe you're referencing from very early. But then as we get into the middle parts of this story, and now as you say, MedMen is public, we're still fighting these insane battles, having to be crazy creative while nobody else understands or is looking, in order to punch through the next wall. And then at the same time, you're dealing with everything that comes with that. There's a story in the book, for instance. There's a story in the book where the Canadian public markets are not valuing our business based on anything to do with the performance of our business. They're valuing our business based on marketing materials and short reports and naked shorts and all the other games that are played up there that I was certainly not prepared for, to one earlier question, right? As a result of us being federally illegal, because if we weren't, I would have gone public on the NASDAQ. Goldman Sachs would have been our banker. I would have had a board filled with people who had seen this movie before, and there would have been a different ending to this story. But that's not real, right? What's real is that as I attempted to create and legitimize this permanent asset class and industry, being federally illegal, not stopping me, I had to do some crazy shit. And we had to pull off some really thin odds outcome plays to be able to do what we did.
Let's talk briefly about what that means, separate from the book, for the cannabis industry, because there are folks in my audience who are interested. We do a segment of the show where we're asking for expert opinions, and it's not easy for us to get opinions on the few cannabis stocks that there are. But, in the early days of personal computing, people could look at the first actors, et cetera. They all thought it was going to be Wang Labs, or they thought it was going to be Prime Computer, or what have you. And they had no idea who the eventual winners, the Microsofts and the Apples of the world, were. Is that where you think we are with cannabis as well? I mean, MedMen was one of the very first companies out there that people were talking about as hey, there's one in this state and one in that state. Is there, in your opinion, have we seen enough development that we know how the industry plays out, in your mind?
No. One, let's just keep going back to it. It is federally illegal inside the country where these businesses are operating. as a result, the ripple for an intelligent audience as yours is, let's talk a little details of what that means. The ripple through everything that supports a business, right? You just say banking is a vague term, but what does that really mean? Well, if you are a lawful business and you are selling a lot of inventory like cannabis retail does, you know this, your audience know this, you access revolving credit lines in order to buy those assets and cycle through them. You certainly don't have to go ask your investors and sell off equity in your company for the cash you need to turn around and buy assets, right? But nonetheless, Bank of America will not give a revolver to Curaleaf or GTI because why? Okay, they are federally illegal businesses, right? And you can trickle all the way down to look at their board composition, look at the C-suite, and ultimately end at, let's look at what their pathway for growth is. And their pathway for growth is undetermined because there's been no M&A and there's been no collaboration between the giants of the effect space and big cannabis. And that is the ultimate answer. That's the ultimate answer you're seeking, which is, will it be Philip Morris on the run of their lives that ends up owning the effect space? Will it be AB InBev that, ends up diversifying further and adds a whole new line of different products that make you feel a certain way that owns this? Because at the end of the day, we are talking about effects. Cannabis makes you feel a certain way, and culturally, it is now acceptable to want to feel that way, and people more than ever are spending their dollars seeking that feeling. Now, who is going to deliver you the products that gives you that feeling? Because we know mainstream consumers will not go out of their way for an extra stop during their day to purchase a single specialty item, right? And because, wait for it, it's federally illegal. No Amazon. No shipping. So we can go through all these things, but how do we know what happens next when it's still federally illegal? Will anybody from this first group, MedMen being first, will anybody be left? Because yes, I left MedMen and 5 years later, the company went bankrupt. But the company's market capitalization and its decrease is reflective of the industry at whole. And then the industry at large has even, deflated more since MedMen went BK, right? The whole thing's in trash. So will there be anything rising from the ashes? That organization will have to go ahead and catch on and connect to some multinational conglomerate that owns effects or wants to be in effects, the way that Kronos put the deal together with Altria 8 years ago, right? In that same vein, it'll have to work out. If it doesn't work out, I think the big guys own effects, and Cannabis 1.0 set the stage, no different, and this is in my book too, right? Look how these stories connect, than online gambling in the United States and the evolution there, right? At the end of the day, it's BetMGM that owns it all and not Absolute Poker and Full Tilt Poker, right? And so how will this play out remains to be seen.
It does. It is a fascinating story. You tell it very well. Adam Bierman, thanks so much for joining me on Money Life to talk about it.
Chuck, it was my pleasure. Thanks a lot for having me.
That's Adam Bierman. His book, Weed Empire, How I Battled Gangsters, Investment Banks, and the Department of Justice to Build the Cannabis Industry in America. You can learn more about the book and Adam at theadambierman.com. And again, we've got a couple copies. We're giving them away in a contest, so make sure you stick around for that. But don't just stick around for that, because, we're going to take a quick break. Could be a smoke break if you want it to be. We'll take a quick break and come back with more of the financial talk when Money Life returns in just a moment.
Everything an advisor needs can be found in one award-winning newsletter. Advisor Perspectives takes the most important financial perspectives and delivers it right to your inbox. Go to advisorperspectives.com and stay informed.
Welcome to the big interview on the May 16th edition of Money Life. Returning to the show today, James St. Aubin. He is Chief Investment Officer at Ocean Park Asset Management. Now, if his name rings a bell, but the firm names doesn't, well, he was Chief Investment Officer for Sierra Investment Management and the Sierra Mutual Funds. And last fall, the Sierra Mutual Funds rebranded as the Ocean Park Funds. And if you want to learn more about Ocean Park Asset Management and the Ocean Park Funds, you're going to go to oceanparkam.com. James St. Aubin, it's great to have you back on Money Life.
Great to be back with you, Chuck.
You know, in setting up where you've been, what I didn't set up is the fact that you are a quantitative and tactical money manager. Obviously, there's a lot of uncertainty right now and a ton of headline risk, but it takes a while for those things to play out. And as I like to say, those things don't become technical events until they show up in the charts. So for you, given that you're quant and tactical, how much has the whipsawing and the uncertainty created opportunities? How much has it just created more uncertainty because it's hard to be a quant guy when the quantities are always changing?
Right. Well, it has been a challenging environment. I think you touched on the idea that the whipsaw effect, right? By one headline, sometimes it takes a while for headlines to affect markets, days, weeks, months. Sometimes it's minutes. And we've seen with the last month and a half or so, those headlines really become very influential in market direction, intraday changes of double digits in some cases. So yeah, that has posed some challenges for a tactical manager like us. What we're really trying to prevent, though, is those large unrecoverable losses. And they always start out as small losses. So what we do is try to apply a trailing stop discipline to our holdings that when they decline beyond a certain point, we exit those holdings and enter cash or other securities that are looking more attractive in uptrends. So we've had a lot of changes to the portfolios over the last month and a half or so, navigating some of this volatility. Whether we're through it or not is probably another question.
Let's talk a little bit about those trailing stops, because it's different for you as a fund manager than for one of my listeners who's doing it for their own portfolio. One of the things I've heard individual investors say all the time is, yeah, I want trailing stops when I think the trend will work against the stock, but I don't want the trailing stop on the day when the market craters and it triggers the stop rapidly given the volatility. So given the heightened volatility we're seeing, are you making your stops tighter? Like, hey, I don't want to experience any of the volatility. Get me out of here quickly. Or are you making them looser where if the market's going to swing a little bit more, I don't want what seems to be a slightly bigger than average day to put me out? Or is that not a problem for a money manager as opposed to an individual investor?
Well, we don't try to tinker with our parameters based on the market environment. We take long-term views on the past behavior of individual funds and apply parameters that would be most ideal for that particular fund over the long term. Now, every cycle, every market event is different, so we can't presume to know whether it's good. The stop level is too high or too low on any given event. So that's why we take a long-term view, a long-term study of the fund's behavior, and try to understand when the volatility is abnormal. And that is an indication to us that they're potentially, on the downside, of course, that is a potential indication that there's more pain to come. And so, regardless of whatever's driving the market volatility in a certain event, or a certain episode, we make a decision that's unemotional, that we don't try to second guess whether or not that's a good decision or a bad decision for this particular environment. It will work many times. It won't work other times. But what we're trying to do, again, is just protect on the downside. And our version of downside protection involves those trailing stops that you mentioned.
So let's talk about how that's worked in these market conditions, because obviously we saw a lot of downside. Now we've seen a bounce back. There are some folks who will tell you, yeah, we're going to test those April lows again relatively quickly. For you, at what point were you basically triggered and getting out of the market? And at what point did you or have you gotten back in?
Sure. Well, right after the Liberation Day announcement, you saw a big drawdown in equity markets and credit as well. That triggered stops on a lot of our funds, as you would expect. But, in tactical investing, it's not just about when you get out, it's when you get back in. And for us, we have buy signals that are indicating the funds that we are potentially investing in are in uptrends. So when the market reversed, we saw quickly buy signals again. So we did see a lot of sell signals, but followed quickly by buy signals because the downtrends were fairly short-lived. They turned out to be a fairly short burst of volatility, and that seemed to become less of a concern. The market overall volatility was short-lived because, it was a headline-driven event, and those can go in both directions, right? So that's how that played out in this episode. We saw the positive headlines quickly follow the negative headlines.
If you have to give an outlook, and I know you're going to rely on the quantitative stuff and the process, but your primary market outlook at this point is what?
Well, we don't have specific outlooks. We don't try to make predictions on which way the market will go. Obviously, it's trending higher right now. Equities, fixed income's kind of trending in a sideways direction. Credit is trending in a positive direction. What we do try to do is understand the risks of the market and what the market is telling you, right? If you look at the market valuation on an equity basis or credit valuations on a spread basis, you see that the market has a very positive outlook, even after all this volatility and lingering uncertainty, I would say, with the tariffs. While I can't tell you whether that's the right or wrong outlook, I can tell you that if the market is wrong, if the market says, well, right now, if you look at the S&P valuation at 21 and a half times earnings, that's telling you that the market is very optimistic, that there's very low probability of a recession. Well, what if they're wrong? I think all that means is that there's a lot of room for downside risk if the market is wrong, if we do see a recession. And the same goes for credit spreads. Credit spreads widened out quite a bit after the Liberation Day announcement, the tariff announcement. And when these tariffs got rolled back or paused, they have come in a lot and going back, not all the way to their tights. The tightest levels I saw this year on high yield, for example, were around 250 basis points above treasuries. Today, they're around 300. So that suggests there's a more risk in the market than there was, say, at the beginning of the year. But at 300, there's still a lot of room for downside risk as spreads would widen again if there was evidence that a recession was coming. So again, right now we went through this really quick episode of, oh my gosh, the recession probabilities have increased dramatically. And then when the tariffs were paused, they came back and said, okay, well, that recession may be a little bit higher than it was before the announcement, but certainly not as high as it was during the height of the uncertainty. So as we look down the road, though, we see there's plenty of reasons to be optimistic. And I think that's what the market's risk assets are kind of pricing to right now in terms of, let's say, corporate earnings and generally strong economic growth momentum. But what we don't know, and I think the market may be underestimating, is just the degree of uncertainty related to tariffs. Now, the tariffs are higher, right, than they were at the beginning of the year. And that is a tax increase, right, that somebody is paying. And that is going to weigh on growth and potentially be a tailwind for inflation. And both of those things are not positive for most assets, including bonds, including treasuries. So I would say that we're in a kind of a no man's land right now, waiting to see how tariffs affect consumer and business behavior. If that turns out to be something that is sort of bypassed, and I think about this in many ways like 2022. 2022 was a year where the Fed had to raise interest rates very aggressively, and sort of the market was selling off, anticipating a recession because it would sort of tighten financial conditions and we get this recession. Well, that didn't happen. The market kind of priced that in, but it didn't materialize. And right now, what we're seeing in markets is that the market expects this to be, somewhat of a headwind to economic momentum, corporate earnings momentum, but nothing that is sort of insurmountable. And maybe that's correct, but if it's not, I think, again, just going back to our looking at the sort of distribution of outcomes, it can leave a lot of room for downside risk, just given where valuations are today.
Obviously, nobody wants us to see that downside risk play out. But I am curious about something that I read in your commentaries back in March before we got to Liberation Day. You wrote a piece that was looking at the risk of America's growing national debt. Then you get to Liberation Day and some potential issues that might make foreign central banks and foreign bond buyers a little more concerned about treasuries. You've had pressure on the Fed to cut rates, which on the one hand would be good for the market, but it might not be good for international confidence in U.S. securities. So I'm curious, given all the headlines, are you significantly more concerned now? Because you sounded a cautionary note back at the beginning of March. And by the way, for my audience, oceanparkam.com, look under perspectives, and you can find James' pieces. And again, this is one from early March. But having written about it back then, are you much more concerned about it right now, given all the political talk and how the national debt could become a much bigger concern and weigh on markets moving forward?
Yeah, so right. That's something that we have been concerned about. It's been what I call a risk hiding in plain sight for some time, that we've had a increasing deficit and debt levels that might cause concern for those buyers of debt, right? So that's already fundamentally heading in the wrong direction. As a buyer of debt, you don't want to see increasing debt levels and increasing deficit levels or high deficit levels. But that's exactly what investors are getting when they're buying the debt of the US government. So right off the bat there, and just to like put that in perspective, our debt to GDP in 2007, before the global financial crisis, was around 35%. And after the global financial crisis, around 2012, it had grown to 73%. That's debt held by the public. And today, after post-COVID, we're at around 100% of debt to GDP. That doesn't sound very sustainable to me. So you already have that as a caution flag for those that are buying the debt of the U.S. government. And you add on top of that a tariff trade war where you are actively engaging, antagonizing potentially trading partners who buy U.S. debt. That, I believe, could add to the maybe impulse to avoid buying U.S. treasuries from foreign buyers. In other words, you're risking the potential for a buyer strike, what I believe Ed Yardeni claimed were bond vigilantes, right? Sort of reaching a verdict on the sort of fiscal imprudence, the fiscal irresponsibility of the US government, and deciding to vote with their dollars and take them elsewhere. Now, we don't know exactly when that will occur, right? We don't know when the buyers will look for other alternatives. We've started to see some evidence that foreign central banks are looking at gold as an alternative to US dollars and US denominated debt. So we may be in the process of that right now. But I think the fact that, of course, everything in the world is priced off of US treasuries. So the value and the price of US treasuries is a very important cog in the global financial system. And if you start to see yields go higher because supply is increasing because of the deficit, at the same time, demand may be waning because of the attractiveness of the fiscal situation. You set up a very difficult situation that could lead to very high interest rates in US treasuries. And we started to see the long end go higher recently. Even during some of the crisis period that we saw in April, the yields were going higher, which is a very somewhat of an unusual response when equity markets are selling off. But big picture is that if we do see that, I think it does pose a risk, obviously, for the bond market, because everything, again, is priced off treasuries. But I think eventually it becomes an issue for the equity markets as well and credit markets.
Yeah, it will be interesting, or maybe a little terrifying, to watch how it plays out. And we have to hope that politicians can come to something that helps to solve this, because this problem is not getting solved on its own.
I don't think so. It requires a very intense response. If you look at the recent tax bill introduced by the House, I think that tells you that they're not actively seeking to make major deficit reductions. In fact, it looks like we could be increasing the deficit very substantially. And so that has potential implications for the buyers of US debt. And they say, again, those bond vigilantes are looking for coherent policies and fiscal discipline, neither of which has the US government been practicing for a very long time. So I just feel like it is, again, a risk hiding in plain sight that investors need to take note of. Now, maybe it goes unnoticed or unaddressed for a long time, and eventually somebody wakes up and we sort of have one of those Minsky moments where it's like, oh my gosh, this is a big problem. But right now it seems to be ignored to some degree, and we'll see if that continues and for how long.
Last question. Everybody's been so focused on the stock market and how it's responding to tariffs and all the things that we've already talked about. But it does seem to me that while the stock market has gotten to where the S&P is basically flat for the year, the bond market is not really buying it. Like the fixed income market is still focused on the foundation of the trade conflict, the not great revenues earned by trade taxes, and the possibility that you'll wind up having some sort of debt problem, as we just discussed, funded by the government as they try to make everybody happy. Are you concerned that in focusing on what's been happening with the stock market, people have been missing the danger that might be present in the bond market right now?
You could argue yes, because if you look at where the S&P 500, as I mentioned earlier, is trading at 21.5 times earnings, you wouldn't necessarily expect the market to put a multiple on the S&P 500 if it thought that this government debt situation or yield levels were going to go a lot higher. So again, what is the market telling you? The market is telling you this is maybe not the best situation in the world, but it's manageable. Whether that's true or not, we'll find out. So I'm not here to fear monger or say that the sky is going to fall next year or anything like that. All I'm doing is highlighting some risks that seem to be overlooked. The market can overreact sometimes and it can underreact. And it may be underreacting to a debt issue in the US that, has been an issue for a long time. These issues can sort of be swept under the rug for a while, but eventually you have to imagine that is unsustainable. I talked about the trajectory of our debt levels. Well, how long can we go? How long can we increase our debt to GDP? At the same time, by the way, interest rates are going up. So our interest cost is going up because of the level of interest rates that we're financing our debt at and the overall level of debt itself. I think eventually that catches up to you. Now, exactly when that happens, I don't know. But the market would have to realize that, okay, what that means is at some point, in order to address the debt problem, the government will have to respond with austerity. Austerity would be a drag on growth, and that would eventually translate into corporate earnings headwind, a big corporate earnings headwind. If I look back at some of the biggest years we've had over the last decade or so in corporate earnings, 2018 and 2021, the common theme between those 2 years was that we had extreme amounts of fiscal stimulus, in form of tax cuts that were going into effect in 2018, and then the COVID stimulus in 2021. Can that be a reoccurring theme? I don't think so. So I think the market that works both ways. It works to the positive in terms of being a tailwind to corporate earnings, but it also can be a headwind. And there's essentially no view that this will ever turn around, right? That will go from, spending huge 6% deficits to something that's much more sustainable, or even, somewhat where we have to start running a surplus in order to start paying down debt.
It's a vexing problem. We're not going to solve it, but I really appreciate the perspective that we gave it today. James, thanks so much for joining me on the show. I look forward to talking with you again down the line.
Thanks, Chuck. Great to be with you.
That's James St. Aubin, Chief Investment Officer at Ocean Park Asset Management. Online at oceanparkam.com. You'll find his commentaries there, details on the funds there, and more. And we'll be back to wrap up this week on Money Life. We got a contest coming and more, so stick around till the end. It's worth it for you, I promise.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
Finishing today's episode of Money Life means packing a lot into a little bit of time, and that starts right away, as I am joined right now by Rob Floyd, the show's executive producer and contest master. Hi, Rob.
Hi, Chuck. And I've got a contest for the book you discussed on today's show, Weed Empire: How I Battled Gangsters, Investment Banks, and the Department of Justice to Build the Cannabis Industry in America by Adam Bierman.
It's a fun read. It was a fun interview. Now I hope we have a fun contest.
We do. And it's all about the weed business. Specifically, I was thinking about how someone might invest in the marijuana business. And given how MedMen, Adam Bierman's company, went bankrupt, I was thinking I'd want to do it with an ETF. And the cool thing is that if you know weed culture, you can pretty much guess at the ticker symbols for the marijuana ETFs.
Yeah, there are 7 or 8 marijuana industry exchange-traded funds, and I can name at least 4 of them with like a guess and a giggle.
Right. And that's without being able to have one that is THC.
Right, because THC is for tenant healthcare and not for tetrahydrocannabinol. Cannabinol.
And there's not one, at least not yet, with the ticker symbol CBD. But if you can guess one of the other funds that uses some references to weed or pop culture, you can win the book. Send us the ticker from one of the fun pot funds, the ones with the cool ticker symbols, and include your name and address, and you'll be entered into a drawing to win a copy of Weed Empire.
I like it. And I also think someone needs to start a pot fund with the ticker CBD. Send your name and your address and the ticker symbol for one of the big fun marijuana ETFs to Chuck at MoneyLifeShow.com by 6 p.m. Eastern Time on Wednesday, May 21st to enter.
And please put the word contest in the subject line of your entry. Good luck, everybody.
Thanks, Rob. I'll announce the winners on the 22nd. Not much time to give you a preview of next week, but Fritz Foltz, Chief Investment Strategist at 3Edge, Carl Mills, Partner at Cerity Partners, Chris Zaccarelli, Chief Investment Officer, the Independent Advisor Alliance, and more will be here next week. So plan to be here. I promise we will get you great guests, even if you're not sure who is coming. If you're looking for something to celebrate, there are a lot of choices. It's Malcolm X Day. It's National Classic Movie Day. It's National Do Something Good for Your Neighbor Day. It's National Bike to Work Day. National Piercing Day. Yow! So I'm pretty sure that's not the point of getting the piercing. It is, of course, NASCAR Day, which is why we started our engines at the beginning of the show. And then on the food front, it is National Pizza Party Day.
Pizza.
It is National Barbecue Day. Feels a little early for Barbecue Day. It's National Coquille Saint-Jacques Day, which I made a few years ago. Fabulous if you haven't had it. And on the drink front, it is National Mimosa Day. That's not on a Sunday, like when you can really enjoy it. And National Chartreuse Day. And I say always on Chartreuse Day, I remember going to the Blue Front Persuaders, an old swing band that played in Ann Arbor and played Chartreuse as a song. And they offered shots that you could buy for like $0.25 every time they were saying the chorus in the song Chartreuse. I also remember getting sick from that. My guests today were Mark Gatto, Co-Chief Executive Officer at Scion Investment Group, scioninvestments.com. Adam Bierman, author of Weed Empire, How I Battled Gangsters, Investment Banks, and the Department of Justice to Build the Cannabis Industry in America, theadambierman.com. And James St. Aubin, Chief Investment Officer at Ocean Park Asset Management, oceanparkam.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Carl Sandburg, who said, "Money withers if you don't know how to nurse it along. Money flies away if you don't know where to put it." Well, don't let your money fly away this weekend. Enjoy the time with your family and all the rest, but keep money in perspective. And remember, until we do this again the next time, the best thing you could do for your money is to not worry too much about it. Have a great weekend, everybody. Stay safe and stay calm. We'll see you here again on Money Life on Monday.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.